Hello ladies and gentlemen, I'm Yuri Bender, editor of Professional Wealth Management. Today I have with me Professor Amin Rajan, the Chief Executive of the Create think tank, which specialises in investment management. Good afternoon, Amin.
Good afternoon, Yuri.
Now there seems to be something stirring in the world of hedge funds. Amin, would I be wrong in assuming from the people that we speak to on a regular basis that there seems to be a sea change developing in how private clients and institutions are looking at these investments, bearing in mind many of them had their fingers burnt during the crisis and during previous crises, but they're reassessing the way they're looking at alternative investments. Would it be fair to assume that?
I think that's a very fair assumption, and it's also right to say that clients had their fingers burnt big time back in 2007 and 2008, and some of the biggest losses were really in the hedge fund space. And precisely because of that, what we've now seen is a major restructuring in the way the hedge funds are manufactured, in the way they are charged, in the way they are delivered, in the way hedge funds provide services and so on. So there's been a huge degree of introspection, and out of that, hopefully, I think we will see a more vibrant and better hedge fund industry.
But if we look at the typical allocations to portfolios, the default allocations, let's say from the private banks, they're still, they're not as high as the 15, 20% we had 4 or 5 years ago, but they're still 8 to 10%, but the private bankers are having a lot of trouble convincing the private clients to maintain these allocations. Do you think they're ever going to be back? As you said, they've had their fingers burnt now, they had their fingers burnt before with long-term capital management and episodes prior to that.
I think they will have difficulty persuading the same clients to come back. Those who had their fingers burnt, they have a new definition of the word pain. And a lot of pain was inflicted on those people. So I'm not sure whether many of them are really planning to come back or are making any kind of allocations. In fact, you're really quite right in sort of saying that private clients got hurt because they were the ones who cashed out most. If you look at the way hedge funds were cashed in sometime in 2008, private clients accounted for 90% of redemptions, despite the fact that they accounted for just under 60% of the assets. So private clients were the ones who really had a mass exit. Many of them are not going to come back. However, the ones who are really coming back have got different investment needs. For example, on the private client side, we're seeing private banks, IFAs, who are advising either pension plans or advising high net worth individuals about diversification. They're definitely recommending hedge funds as one of the components of diversification. The amount of money going in is not huge by any means. In fact, I would argue that a lot of recovery in the asset values, the AUM in hedge funds, have been largely due to recovery rather than the advent of new money. So new money is slow in coming in, but it is definitely coming in. And the new generation of clients are demanding very different things.
And where does UCITS 3 fit into all of this? Is this just some kind of cloak, some kind of Trojan horse to persuade investors that this is a hedge fund but not really a hedge fund, or does it really serve a good purpose?
I think it probably on balance serves a good purpose, but time will tell. These are still early days. I think what is called the UCITS industry, which uses hedge fund type tools in the conventional UCITS funds, that is still a nascent industry. The amount of money that has gone in there is not really anything like as big as made out to be in the media. I reckon something like 190, 200 billion of assets have gone into UCITS compared to 7 trillion overall size of the UCITS market space. So we're talking about a small sum of money. However, what has happened here is that clients have been persuaded about the merits of hedge funds. Clients have also been persuaded about the merits of UCITS, because UCITS is still seen as a kite mark of excellence in terms of the way risk is controlled and the way rules are complied with, in the way transparency is offered and so on. And many clients really like UCITS framework very much. And then when you start applying hedge fund type structures to UCITS, their appeal has increased. There is no doubt about it. And interestingly enough, we're finding in our research that much of the new money going into UCITS is coming from the institutional space. These are institutional investors outside Europe who use UCITS as a vehicle for diversifying their investments, and they're showing quite a lot of interest in UCITS funds. Now, they're relatively new, as I said. Their charge structure is nothing like as prohibitive as the usual hedge funds. We're not sure what kind of returns they're likely to deliver in the medium term. I suspect they're not really going to be shoot the light out type returns, nor at the other extreme. You know, they would not really deliver big losses in a way that the pucker hedge funds had done. So I think we probably see slight improvement in what UCITS had delivered before, but that will come at a price.
But UCITS has been with us for 20 years. All the talk now is about the AIFMD regulations looming from our masters in Europe. These regulations, do you feel that over the next 10 to 20 years, perhaps there could be AIFMD branded products which might be acceptable all around the world as the alternative standard in the same way that UCITS is today?
I think the way the world of investment goes, everything is possible. I started writing about UCITS back in 2007, 2008. And even at that stage, nobody thought that the regulators would allow shorting and leverage in UCITS funds. Okay, they're doing it through certain instruments, you know, rather than allowing a physical means of shorting and leverage. But I never thought that that would be allowed. In fact, when the Irish first raised this issue, you know, they had their knuckles wrapped. So anything is possible. And I think regulation, although it leads to some negative unintended consequences, UCITS regulation and even the new AIFMD regulation, they could actually generate positive benefits if regulation is used properly.
And what is the reaction to hedge funds currently in the Far East? You've just done a major Odyssey-style tour of Asia, I think visiting 6 different countries in a couple of weeks. Yeah. What are the reactions to derivatives-based investment vehicles in China, Hong Kong and the surrounding countries there?
Yeah, you know, in one sense, you would think that the world of alternatives have completely bypassed Asia. And you would be forgiven for thinking that. Let's start in Australia, for example. You know, Australian market is a very sophisticated one. You know, they've got the super funds, and the amount of money in super funds is just absolutely huge. Nearly up to $1 trillion, Australian $1 trillion. Even in a market like that, we find that investment behaviors are still very conventional. You know, 60-40 equity bonds type of asset allocation is very common. Insofar as people have diversified, they've gone into REITs or into property, and latterly, on a small scale, they've gone into infrastructure. But the amount of allocation we're talking about are very small. Bulk of the assets are in conventional equities and conventional bonds. So hedge funds have not really made a mark in Australia. There are some isolated examples of super funds who have really taken up hedge funds, but nothing like the sort of allocation that we've seen in the United States or in the UK or even on continental Europe. Then when you leave Australia, you go to Singapore, then you go to Malaysia, you go to Hong Kong. In most of these countries, you know, they don't really allow hedge fund type structures because shorting is not allowed in many of these countries. The basic idea is that when you invest in a product, you invest for its intrinsic value, and you don't want any funky stuff around it. And hedge fund tools are seen very much as some kind of funky overlays, you know, which is designed to produce wonderful returns, but it can also cost a huge amount of money and can also end up losing you a lot of amount of money. So in many of those countries, they really haven't bought into hedge funds. Then when you go into Japan, insurance companies have shown interest in hedge funds. But you know, when you really look at the allocations, it's very small. Vast amount of the allocations of insurance companies and large institutional investors in Japan is really in equity funds, which are indexed, or they are in government bonds. Then when you go into China, the same story again. Huge amount of money invested in simple post office savings account. And so hedge funds as an asset class or as an investment strategy really hasn't taken root in Asia Pacific. Partly because of the prevailing regulatory climate, but mainly because the asset allocation choices of these countries are just so conservative and so traditional. And they seem to have done well out of those choices.
Well, that really brings me on to my final question to you. I mean, that you're talking about strategic asset allocations here, but the private banks we're talking to in Switzerland, in Europe in particular, and in Asia, now have a huge emphasis on tactical asset allocation, aggressive, fast responses to the changing global macroeconomic environment, with the unrest in the Middle East, with the tragedy in Japan. Is it perhaps a case that hedge funds aren't really suited to this kind of environment?
I think part of that environment would favor hedge funds, in the sense that many hedge fund managers are very active traders. And the hedge funds are no longer in what I call the calendar time world. They've moved from calendar time to real time world. And insofar as they've done that, they're very good on active trading strategies. Having said that, I think the kind of dynamic asset allocation you're talking about, it really applies to large portfolios. Where you've got some money in bonds, some in equity, some in forestry, some in real estate, and so on. And dynamic asset allocation is done very much at the margin of it. So you may move 10% of your assets from one asset class to another, and so on. And in that kind of portfolio, hedge funds don't feature very strongly. So if hedge fund managers decided to be part of the dynamic game, I think they can play it. But most of them don't really play it because their money is entirely in hedge funds. Whereas with the other lots, they're in different asset classes. And a lot of this dynamic switching is done by switching between asset classes rather than within a particular trading strategies. So hedge funds are not really part of that deal.
Yes.
But more and more of them are now going into long-only space.
Yes.
More and more of them are also going into long-term illiquid assets like infrastructure and so on. So the world of hedge funds is actually changing quite dramatically.
Professor Rajan, many thanks for your comments.
Thank you, Yuri.